Hey everyone, glad to be joined here by Phil Super today. How you going, Phil?
And good, man. Good. Happy to be here, man. Thanks for having me.
No stress, man. I thought it's about time we catch up and,
Yeah, for
with
sure.
your expertise in lending, talk a bit about, again, whatever you're seeing in the market, what we're seeing with some of our clients as well, and hope to
Yeah, of course.
share some knowledge to our fans.
Yeah, no, we've obviously worked together for a while and we've had a lot of, good times as well with our clients. So I hope we can try to share all their, tricks that we've learned obviously on the way with all our clients. So it's good.
100%. And today, Phil, I was more wanting to discuss, about people try to enter the market for the first
Mm,
time potentially. So I thought it would be really great to share about what we're experiencing, from our clients and what we're seeing from a lending perspective, especially from,
mm,
let's say people under 25, under 26 years old or buying their first property and unknowingly facing challenges with getting borrowing from banks. So
mm.
I'll lay out the scene just very quickly because I know there's a lot of things we want to touch base with here, but
Yep.
what we're seeing with clients, especially over the last few months, and it's a no fault of the client because theoretically they've done everything right. They've
Mm,
gone to high school, they've got a good ATAR, they've got to uni, they've done a great degree, they potentially have done their master's degree as well, and now they've just started working full time. They've hit, $100,000 salary by the age of 25 years old, but during that time they've amassed maybe a certain HEX debt. We've seen
mm.
clients trying to come into the market with a HEX debt of 50 to $70,000, give or take. We've seen people take on a car loan as well, maybe just a credit card for traveling, as an example,
Yep.
afterpay, pay now,
Yep.
buy now, pay later services as well. So
Mm.
what we've been seeing is that's just a requirement in today's society, just given the fact that, cost of living has significantly increased. It's not easy
Yeah,
to save up money, go traveling,
100%.
buy a car with cash today. And what we're seeing now in the market is when we take on some of these clients and then we take their scenarios to your team, we
Mm.
take out some of their kind of proposed lending from different lenders in the space, and we're seeing a lot of the clients can't borrow more than like $200,000. And
Yeah,
these are people literally thinking, they've done everything by the book. They've
yeah.
studied, they've got a great job, they've got a solid career, they've started that foundation for themselves, and
Mm.
now they've just found out they can't buy their property.
Yeah.
And it's very unfortunate. And we try to educate people on, good debt versus bad debt, but there's so many factors. So just want to touch base with you. And what tips would you give to someone to kind of avoid that scenario?
Yeah, no, you're definitely right because a lot of people thinking they're doing the right thing, they've gone against the mold. Even those really high achievers that did really well, they probably went into a grad program at uni, and their first job is about 60, 70 grand out of uni. And as you said, that can only potentially get you, 200,000. And what we're seeing is people, one of the hardest things I'm seeing is people are getting overwhelmed, right? So especially us being based in Sydney, a lot of clients would prefer to invest or at least buy somewhere near them. And when you're looking at medium house prices in Sydney and they just think, well, first thing out of uni, they just kind of get overwhelmed and they think they have to, save up like 300 grand to actually be able to have enough of a deposit. But and also interest rates being so high, that's one of the biggest things that's actually hurt a lot of borrowing for people as well. But the catch to that is that, banks are being a lot more flexible and especially for certain professions. So for example, I was actually running an afternoon tea for a bunch of junior doctors last week. And the big thing about them is exactly what you said. Like these guys are doctors, right? And they kind of feel like they can't get into the property market because their income is, so low at the moment. They've spent all this time studying, and some of their hexes are almost $100,000 for some of them, which is
Yep.
huge, right? And they've done the right thing. They've become a doctor. They've gone to the best hospitals. They're trying to help people, and they see that salary when they're 35, 40 being, three, 400,000, but right
Yeah.
now it's not there. Right.
Mm.
And what I'm seeing is in a person in that kind of scenario is okay, let me get into an apartment first, right? And then once they try to get into an apartment, okay, let me sell that apartment and build from there. And then
Mm.
you're seeing a lot of kind of transaction cost in the way, and that's hurting them even more,
Yeah.
right? And that's when someone like me and you come in, where we will say, okay, well, you actually don't have to just buy the apartment that's next to you just because you can afford it, right? We're seeing people go to buyer's agents and buying a property with great growth and then buying what they really want 2, 3 years down the line. So it's really important at the beginning, one, to not get overwhelmed, and then two, to kind of plan it. Because most people, when they purchase a property, especially in their 20s, it's not an overnight success. They've planned it, they've saved for it, they've done their research, they kind of know where they want to buy. And right now, it's as easy as ever to buy interstate as well. So people that are kind of being out of the market in their city, whether that be Melbourne, Brisbane, Sydney, and they're looking outside of that, you're seeing that being easier and easier, and people believing in people like buyers agents and brokers more to actually advise them of all their options. Because, as you said, someone might graduate, go to whatever profession that they have, they go to Westpac, they go to CBA, the first bank, they're only getting $200,000 and they kind of give up. They're, okay, well, maybe I just need to save more. Whereas now there's so many different options to actually enter the market. For example, a lot of people are using this new bank called Own Home. I'm not sure if you've heard of them, but what Own Home do is they kind of specialize in that person that's actually gone to uni, or even if they've got a solid income, you don't strictly have to go to uni. But if you're making, say, $90,000 to 100,000 or even more a year, what they can do is actually pay for your deposit to help you get into the market, right? And then from there, hoping that the loan will get paid down lower. That way they can actually refinance that debt and have more options down the line to get what they really wanted. Does that make sense?
Yeah, 100%. And I think you touched on some really interesting points, like, for example, people in the medical profession. So these are, smart people and they've got, lofty goals and they're in a great career, but they're also so limited financially because to your point, you might have been studying for 5 to 7 years and now you have a HEC debt of, close to $100,000. And that's really limiting your borrowing capacity. So what we're advising clients as well is obviously to seek creative lending sources and speak to people such as yourself, for example. But also just if you look at the macro environment, it's so important to keep upskilling and also create multiple revenue streams as well.
100%.
And it's almost becoming so difficult just to, take the next step in life because one job might not be enough today, just given like there's some mandatory debt you have to take on across the way. But upskilling, allowing yourself to have, another revenue stream, maybe potentially working that second job, it will pay off in that first, 5, 10 years of your career if you can secure a high growth asset. And you mentioned obviously it's so easy to buy interstate because you can talk to experts. For example, we always tell our clients like you probably theoretically you might not need us after the first property, but it's so important to get that first property right. So your
Yeah.
foundational property will give you that growth, and then you can leverage that property, take out that equity, and then make sure you use that for your next deposit. Because the hardest thing today is saving for the initial deposit as well.
Yes.
And I'm
Yeah.
sure you've seen some of the results which we provide for our clients, but that's ultimately our goal. Like we want to make sure that property one is not just limited to one property and set and forget. That property one will turn into a scalable portfolio that helps them get to their financial goals, which is very crucial. But like for example, if you're seeing people come into the market, you mentioned own home, but if someone's maybe 23, 24 years old, they're looking to start their investment journey or potentially use a first home owner's grant.
Yeah.
Then they've got high debt of HEX. They've got high HEX debt. They might have a car loan. They might have a credit card. How would you advise that client? What steps can they take in that scenario? Would it be mainly like creative lending, or can we look at other avenues here?
The first thing I would actually ask them is, are you actually going to live in the property?
Yep.
Because a lot of these government incentives, they do help people actually get into the property and they do work for that. But in terms of strictly an investment perspective, it's a bit short-sighted. And why I say that is because there's a lot of restrictions involved once you actually purchase that property. And you also lose a lot of tax benefits to that property
Yeah.
as well.
Yeah.
And on top of that, you probably actually got a lower loan than you would have if you actually were using an investment perspective, because you actually are gaining rental income. So therefore, your income is actually a little bit higher. I'll give you an example. So first and foremost, the first home owners grant really in Sydney, it doesn't really work unless you're buying an apartment, really, because the limit to that is $1 million, and anything over $1 million, you're basically not getting any assistance from the government.
Yeah.
So for someone to kind of force themselves just to kind of be approved and get free money, it doesn't work as simply as that, because that first year that you haven't gotten rent, that you've actually been living in the property, which is one of the restrictions, you have to be there for 1 year, you've lost maybe $20,000 in rent, which is more than what you would have saved from the government anyway. And the best thing about it is at the end of the year, your accountant is going to give you a nice tax return because of all the negative gearing that you might have gotten as well. So that's another boost that people do. People are trying to, game the system and think it's like a loophole to actually get in. But
Mm.
the government has designed it in a way that it's actually only benefiting you if you genuinely want to live there. And if you genuinely want to live there, then of course it's fine. It's great. It's a great incentive and it is going to help you get in the market because $20,000 or 15, whatever the stamp duty may be around there is a big deal, right? But if you're going to get that in rent, maybe if you can do it that way, that might be benefiting you that way. And if you've got a bigger budget now because you're getting rental income, that's the advantage of having a specialist like you to actually purchase a property where you know that this is the goal for 5, 10 years, maybe 15 years, not the goal for 1 to 5 years, because we want to
Yeah.
look at as much as we can and everyone gets a benefit with as many transactions as possible, right? Because if you've purchased a really good asset and you've helped the client purchase a really good asset, that opens so much more windows down the line where when life events comes, things changes, you get married, you have kids, you're kind of prepared for that, where you're not trying to catch up. You've already kind of set the foundations, as we've spoken about, really well, chosen something that's actually going to be a long-term thing, not just trying to get whatever's available
Yeah.
and not trying to cheat the system because it's not really to your benefit. You don't actually benefit from it in the long run. Yeah.
100%, yeah. And I love the facts you pointed out because they're facts about that first home owner's grant. So like we've had so many clients ask us, I'm
Yeah.
trying to purchase a property. Shall I go in and use my grant in this specific location? And a lot of
Yes.
the times they're not going to be living in the property. And
Yeah.
even if they are, the fact that they still want to scale a portfolio in the future, going in with, just a 5% deposit, so a 95% LVR from the bank, the lender, means that it's very difficult to get another loan for another property down the
Yeah.
line. Even if your
Yeah.
property grows in value by even 150, 200 grand, taking cash out with just a 5% initial deposit is close to impossible. So
Mm.
that's why we always advise clients, if you're genuinely looking to build a portfolio, invest, do not use the first homeowner's grant unless you're, again, living in the property. 100%
Yeah.
agree with that. Because
Yeah.
you're right,
And
the benefits are just not there because you're losing on the rental income for sure.
100%. And to your point also is interest rate, right?
Yeah,
Because you've put a low deposit down and you've kind of forced yourself into an asset that's not growing, you would have to pay that down yourself. Whereas if
yeah,
you've seen a property jump up $100,000 over 2 years or something, which is not unrealistic, we can then negotiate a better rate for you as well.
yeah,
Because the bank is going to look at you as, you've got a $600,000 house, your loan is only worth 400,000, you're not very risky. We'll be able to help you out with your rate, which is what our job is to negotiate for you on your
yeah.
behalf. Whereas if you force yourself to buy a property that's of lesser value just because you wanted to get in and use that and it doesn't grow, you could be stuck on a high rate too, as well, which is another negative that people might not
100%.
consider.
Yeah. The
Yeah,
more you borrow from the bank, the more risky you are, the higher your interest rate is.
100%.
And that's what people
100%.
always have to understand.
Yeah, 100%.
Yeah.
And even getting debts, I've heard, another thing that clients will, once they're trying to get into the property, they'll see their credit score might not be, at the top.
Yeah.
And they'll say, okay, well, let me get a credit card then so I can pay it off quickly and then I
Yeah.
can get a higher score. But it doesn't really work that way either, because if you get a credit card, the rough figure is about whatever the limit is. 5 times that is what you'll lose on your loan. So if you've got a $20,000 card, you can potentially lose $100,000 on your mortgage. So, and the banks aren't going to punish you because your credit score isn't maxed, right? It's only if it's really extremely low that they'll start to
Correct.
consider. Yeah,
Yeah.
but I've had clients ask me to just take out loans and debts just to help their score, just so
Yeah.
that they want the loan, they get a lower rate, but it doesn't really work like that.
It's very unfortunate the society we live in because with the cost of living crisis, everyone's just thinking about new ways to accumulate debt, almost
Yeah,
just to pay off other debt today. And
yeah,
that's why I really genuinely feel bad for, first home buyers or people looking to
yeah,
enter today's property market because we've spoken about this countless time and wages are nowhere close to mirroring, the rate of increase for property prices today.
yeah.
So what advice would you give to someone who's, coming to the market? They've got an option to take on some bad debt or not
Mhm,
to. What are the
mhm,
main do nots? So if someone's thinking about buying property today,
mhm,
looking to buy the first property, whether it's their own home or whether it's an investment, what are you mentioned a really great point about for credit cards, for example, how much it can impact your borrowing. What are the
mhm.
main types of bad debt to avoid from a lender's perspective?
Yes. Yeah. So obviously credit cards is an easy one.
Mhm.
Personal loans.
Yep.
Even one thing that people don't think about is buy now, pay later.
Yep.
So, I used to work at Macquarie Bank, and they're very stringent in what they check for their client. If you've got a bad history, or if you've been missing payments, and then I also see a buy now, pay later, like Afterpay or whatever that may be,
Mhm.
that could be a sign from a bank to say that, or maybe this person is struggling financially. That's why they're after these short-term lending,
Yep.
or even those cash converter style loans where they're only for like a month or so, and you only need $2,000, $3,000, and you just needed something to get by for the meantime. Obviously, things happen. If you don't have a choice, you don't have a choice. But that's something that I'd always try to avoid, is that just because it's convenient and you're going to pay it off quickly, and oh, it's only $100 of interest that I'm going to be paying, it's still a red flag from a bank's perspective, because if you're borrowing a mortgage, why do you need these small loans? Even
Correct. Yeah.
and what benefit are you
They
actually
they
getting from
flag
it?
a cash flow issue, basically.
Yeah,
Yeah.
exactly, exactly. The tricky one though is Hex, right? Where
Yes.
and there's a balance between paying it off and not paying it off,
Yep.
right? Some people have the thought that you don't want any debt at all, and everything has to be safe, so you pay off your Hex and do that first. But that doesn't really make sense as the doctor example, as I said, right? Because if you've got $100,000 to pay off your Hex, it probably would benefit you to put that $100,000 in a home that's going to actually go up in price,
Yeah,
right? Where you're
100%.
actually making money from
We
that.
always do an analysis on the hex payment, for example. So,
Correct.
if someone's got 20 to 50 to 100 grand of hex, we look at what's the right level you possibly can pay off to get, a lot more borrowing. So, for example, if you're paying off 20 grand of hex but getting 100 grand more borrowing, which also depends on your personal situation overall, then
Of course.
100% we'll consider making the payment. But if it's
Yeah.
not really, moving the needle from a borrowing power perspective, then to your point, why not just keep the cash and use
Keep
it
it.
towards deposit?
100%.
Yeah.
And a nice example that I always try to use, and something that I learned at uni and just stuck in my head, is just
Yeah.
that if you've got $100,000 and you want $100,000 car, you probably shouldn't just put it in the car. Why
Yeah.
don't you find something that's $100,000 that's going to make you money and then borrow for the car, right? At least you've got something to
So
kind
I'm
of
guessing you're
back you.
saying no car loans.
No car loans either, yeah. Unless it's a Supra, because I really like Supras. I
Yeah.
love that. Yeah. Other than that, no, I wouldn't do it either. Yeah. But yeah, to your point at that though, that's why it gets a bit tricky as well. Because if you're a business owner, you might benefit from actually getting a car loan.
Yeah.
You might actually need that cash flow for your business and for the home as well. Like if you wanted to buy a property that you wanted to sort of flip and you needed that cash, maybe it makes sense to do that. But that's when accountants and financial advisors comes in,
Correct.
and
Yeah.
that way, we've got the playbook. This is the playbook. We can give it to you, and
Yeah.
then we can decide with a professional whether that's going to benefit you or not, and then we can take it from
Yeah,
there.
I think for anyone with, like a more complex scenario, or if you're running your business, or
100%.
there's so many different complexities with the, loan arrangements, definitely just have a
Yeah,
call with any professional. Like,
yeah,
we always have multiple consultations and we get,
yeah.
your team involved as well to make sure we give a very accurate view of what we can and cannot do in the market. Because
Mm,
full transparency from the beginning is very crucial. But
yeah,
so let's say, for example, no hex debt. Ideally, that's the dream scenario. But you've got some hex debt. But the things you can avoid: car loans, credit cards, afterpay. I've even heard, for example, like sports betting and gambling, for example, can make an
yeah,
impact as
yeah,
well. So I think
mm,
these are the kind of things that awareness has to be created because a lot of people are starting the journey not unaware. And
yeah,
I can go on about, the educational system and, how many things that don't teach you about, finances and kind of
of course,
progressing in life and purchasing property.
endless.
But I think these are things we're constantly educating our clients on. And ultimately, it comes down to just be disciplined, have some
Yeah,
consistency. And if you have a goal to start your investment journey, the hardest
mm,
part will be your first property. That's always
100%.
what we tell every client because it's not easy to save, 70, $80,000 in today's market.
Yeah,
I 100% agree. It's not easy to be disciplined and, while your friends might be going traveling and avoid their credit card or to your point, everyone's buying, a Supra or like, back in our day, Skyline or whatever you're buying. And that debt is just going to limit you so much. But if you think about it in the way you described it, if you put your money into assets that will genuinely grow in the long run, you can do all of these things in a lot more comfortable manner. It just might take you an additional 5 years. But to your point, we have the playbook. We can
mm,
help you get there in a very comfortable way. And we have, again, full transparency. We give you all the numbers up front. So you understand cash flow, you understand how it impacts your lifestyle. You're not going to be buying a property and just be burdened with a mortgage and think, hey, what do I do now? Because I'm just drowning in, repayments. It's not the way this works. And we have, options and lending scenarios for every single client, which I think that's the way we work together. And that's what really gives the benefit to the client at the end.
And to your point on that, we're not going to try to max out your loan and buy you the most expensive property either,
Yeah,
because that doesn't
100%.
make sense, right? We want
Yeah,
something that you can afford, that you're comfortable with, and we want you to enjoy your life too, right? Your life isn't about mortgages, right? It's hard to have that delayed gratification. And as you
yeah.
said, want to go to Europe, they want to buy this car, but what they don't realize is that, you could buy a property in a regional town that might be 400, $500,000. That's
Mm.
actually a good asset. And that's not that much harder to get in, but just not to get overwhelmed by it. Because
Yeah.
if you can get something like that, that way you can set that foundation and have a lot more planning in the future. And then you can decide on more things as well from there.
100%, yeah. And even in today's market, we can still buy, big, large regional cities, capital cities for less than 500 grand. It's still
Yeah.
possible. And these
Yeah.
are, qualified locations. And I think that's one thing you were mentioning, Phil. Like, are you having a lot of, discussions with clients on, affordable regions? Is there like
Yeah.
a certain type of property, for example, that people might be looking at without, expert guidance, for example?
Yeah, so I'm seeing a lot of attention going to Queensland, especially
Yeah.
regional Queensland. And so I'm seeing a lot of people, especially with the Olympics, I feel like that's given a lot of like energy to that region. And
Mhm.
also, I've had a few clients actually ask me, I'm not sure if you've heard of this, of those interstate train lines that they wanted to do from Brisbane to Melbourne, those
Yeah.
high-speed trains, and people are saying, should I just buy a regional town and hopefully I can get lucky? And
Yeah.
that is a strategy that some people are considering. But I'm seeing the most in Queensland and not so much in New South Wales. And I think you would probably know better than this, but I think it's more the price point where you can still get a really good asset for
Yeah.
that 400, 500 mark. Is that right?
Yeah, 100%. And we'd always get a lot of clients, talking about the hotspots. So your
Yeah.
Townsvilles of the world, for example. And again, it's driven by, a lot of growth in the last few years and it's still fairly affordable today. So we always advise clients on numerous factors before we start, sourcing the property. There's nothing wrong with Queensland today by any means. You will definitely find properties under $500,000 there, but we also consider market cycles, where certain locations are in the growth cycle, what kind of government spending, what's the economy like, are we too dependent on one or two industries, for example. That
Mm,
comment about the Olympics and all the infrastructure spend, the train line, that's all amazing, and there's a lot of infrastructure happening in Brisbane right now. Are we personally focused on a lot of areas in Brisbane today? Again, it comes down to affordability and what the client's risk appetite is, how long they're holding the property. So it
mm,
might suit some buyers, it might not suit a lot of buyers as well. For
mm,
us personally, if you're investing in an area, you want to see the affordability cap allow for at least 30 to 40% growth as a minimum in the property. So, if I'm going to a regional Queensland area today, what are the probabilities and fundamentals showing me that we'll be able to see that growth? Because
mm,
otherwise, there's a high risk of holding that property. Because I'm assuming, especially today, in Northern Queensland, regional Queensland, a lot of investors have gone into the market. And by no means am I saying that market is not going to grow. I think it'll perform really well over the next 12 to 18, 24 months. But we don't want investors stressing out over a property purchase because property is a long-term asset. It's a very real has a real human element to it where people want to live in this asset. It's got a real intrinsic value. So you want to be able to secure the property, hold it for a long time frame without thinking about is a price going to be volatile. And so those are just
mm,
things we always discuss in property strategy sessions before we place clients in any location. So
mm,
to answer your question, I think that's great. People are thinking about Queensland or regional Queensland hitting that price point. They just need to make sure that again, it's not just the one purchase. How does it sit within your portfolio as well? So,
mm,
in all transparency, if a client had a very strict budget today, that would definitely be a top option for us. But there are no other timeframes for the property. What we're thinking in terms of how long you might want to hold it before you potentially move on or look at the opportunity cost of not going to a different market, for example. They will know the
mm,
risks as well. So, for example, natural disasters, council rates, investor ratios, all those kind of things. And then we'll make sure to understand what are the opportunity costs of not investing in a different market that might not see the same growth over the next 6 to 12 months, but it might outperform that property market for the next 5 to 10 years. And that's
mm,
very crucial because
mm,
it's all about, again, the entire portfolio. So it's very different for an investor who's bought like 5 or 6 properties and they're now looking to diversify in a regional Queensland region. Whereas someone who's buying their first investment property in a regional location that has just grown like literally doubled in value over the last 2 years, and now you're placing your bets
yeah,
there for that last, 10% of growth, that becomes a
mm,
very different conversation. And that's where I think, again, to your point, a lot of people have now come into the market. They're more aware about the locations across the entire country, for sure. but they're also not educated enough to understand from a portfolio long-term perspective what that actually means for me and what are the risks involved. And I think
Mm.
that's where just talking to an expert will just help you understand these things. By no means am I saying you need to engage with us, but have, more than one data point, have more than one, kind of news source, like just saying, rather than just looking at the media and saying, regional Queensland's booming today, let's avoid all the, the hype and look at the pure data, understand the real fundamentals of growth and where a certain market is in that cycle, and then make the decisions from there.
And in saying that, for me personally, I see a lot of attention in regional Queensland. Do you know why that is compared to, some other states? Do you think there's a reason for that and why there's less interest in other states? Is it purely price?
I think it's purely price. I think the affordability factors there, like I said, like if you literally go north of Brisbane, so many regional areas, they're consistently priced, $500,000 and below. So it just
Mm.
means that people can afford properties there. The yields are
Yeah.
stronger than New South Wales, are stronger than Victoria. So it helps with your servicing, so it helps with your loan as well. So you get the rental
Mm.
appraisal in, you can borrow more for a property in Queensland today,
Mm.
and likely most buyers will be able to borrow in that price point. And
Yeah.
that's, I think, again, perfectly fine because affordability is crucial in today's market. Again, there's nothing wrong with the growth there. I don't think that's going to be, a bad market to buy in by any means. I just want to make sure that people understand that, there might be a certain cycle that we're in for, regional Queensland areas. And given the
Mm.
amount of government spending that might be going on in certain locations, or, just be aware of, what kind of industries are driving some growth in certain locations as well, then you can understand, what that property will do for you long term. And as long as you
Mm.
understand everything, then you can make the decision if that's the right area for you.
Mm. And when you are sourcing properties, how much effort do you put into like government debt? Like for example, Perth is an example where basically every year the government is in a surplus and you see
Yeah.
that spending coming back into the city. And then you see a place like, Melbourne and sometimes Sydney where the government is actually selling their assets and they're
Yeah.
actually trying to get rid of their debt. So how much do you pay attention into that and also like infrastructure plans?
That's a great question. And I love that you asked that because we're a firm believer, for example, that Perth is nowhere close to done in this growth cycle. And
Mm.
like
Okay.
a part of it is honestly what you just said, like their surplus, every budget is like more than $3 billion. Their economy is booming. They've got some of the highest household wages across the entire country for numerous reasons. So that economy is doing really well. And then we look at all the other fundamentals for price growth from a supply perspective. They're historically low in supply. There's nothing new being built in Perth, for example. Then from a
Yeah.
demand perspective, they're having some of the highest internal migration externally as well. Very affordable area. Jobs are being created. So Perth is an economy, again, to your point, that we look at that government, deficits or, surpluses for sure. We look at,
Mm.
the unemployment rates, all the government projects are spending. That should be, again, showcasing economic growth because ultimately that creates more jobs. More jobs means household incomes are increasing, which ultimately means properties will become more affordable. So
Yeah.
Perth is a great example of, an economy that's doing really well. And then to your point, Victoria, like again, if you look at again government debts, yes, 100% Victoria is in debt. But if you take a step back and just look at the scale of that economy as a whole, that's a very different economy. It's going to be Australia's largest economy over the next like 10 years. And that's been proven by numerous ABS and other data sources as well. They're still going to have the highest population growth over the next 10 years on top of that, and going into 2050 and beyond. So you're
Mm.
looking at a city that's going to become Australia's largest by far. So yes, even though you might see the government being in a slight deficit today, we'll look at other factors and never just focus on one data point. We always look at factors like unemployment rates. What's the demand coming in? Are there jobs being created today? Even, for example, they've got one of the largest projects happening in the country right now with Westgate. Certain projects, yeah, might be on hold or they might be, paused for a smaller time frame, but these are still going to be implemented over the long run. You've got, massive infrastructure projects, metro projects, upgrades to the airport happening right now live. And these are billions, like hundreds of billions of dollars in government spending going to improve that city. So you're seeing, yes, government deficit today, but you look at the scale of the economy, you look at those fundamentals, long term, you can't go wrong, placing your bets into Victoria just because you might see, a slight government deficit today. So I think,
Yeah.
just again, it comes to we never just focus on one data point. 100% is a very, very crucial, thing to look at from a government deficit point of view and how the economy is performing, but we take everything into account.
Mm. And that's like what I feel as well. I've
Yeah.
got the same kind of view as you because a lot of clients will ask me, well, oh man, Sydney is so expensive, like what if the houses just drop? But
Yeah.
it's not as simple as that because of what you're saying, because of how much growth and how much money is actually being pumping in and how much our economy and population is just growing, right?
Yeah.
And even though from what I've seen is there are places where it has gone down, but overall there are still great performing suburbs, and it's as we always say, markets within markets, right? So
Yeah.
it's never as simple as, oh, Sydney went down by 1%, get out of Sydney, or Melbourne hasn't gone up 10%, let's just leave Melbourne completely. It's very because I actually went to Melbourne at the end of last
Yeah.
year, and especially the west side of Melbourne has a lot going on. They're really trying to grow that region.
Yeah. 100%.
Yeah.
Yeah. I think you brought some great points. It's really awesome.
Yeah. And also, what about another topic that a lot of people do ask me about is rent vesting, right? So we have a lot of customers as well that, in Sydney, and they're kind of growing their portfolio, and
Yeah.
they've come to us and they want, a $2 million house, but then all of a sudden they're like, oh wait, the repayments are really high. And if I rented that property, it's basically, a third of the actual payment. So are you seeing a lot more clients that are trying to just strictly rent vents and not ask you for an owner occupied, just ask for investment?
Yeah, 100%. And I think a lot of the times they don't even know that they're looking at that rent vesting strategy. We're kind of just
Yeah.
naturally going towards that direction, and then we explain the benefits of that to them. So
Yeah.
we've got so many people thinking about potentially buying their own home in Sydney or buying their own home in Melbourne, and we break down the numbers to them, which is very crucial. If you
Mm.
break down numbers, cash flow, everything to, a potential client, they'll understand straight away if they can afford something and if it's
Yeah.
feasible. So if you're buying a home in Sydney, you're paying what, let's say $1.5 million dollars. You're looking at like, monthly repayments of, close to $6,000 for that property in today's interest rates. A lot of
Yep.
people cannot afford that. So if
Yeah.
you rented in the exact same area, same location, didn't compromise on lifestyle one bit, apart from the fact that yes, you might move your house every year or so. I understand that, but you're paying probably half the price from a rental perspective. And instead of owning one property, you can then probably split that $1.5 million of borrowing across 3 or 4 assets potentially across,
Mm.
different states, diversify the portfolio, and you're buying in locations that have a much higher chance of growing for you. Because I'll be very transparent, we're not investing in Sydney right now. This
Yep.
is not a market where we feel that we can confidently buy a $1 to $1.5 million asset and will outperform the Australian national average growth. We don't see that happening in Sydney today. So it all comes down to, again, if you showcase all the numbers and make them understand the feasibility of, buying your own home versus rent investing, then a
Mm.
lot of clients have naturally, gone towards the strategy. And yes, the old, saying is, you don't own your own home. Are you poor or what is wrong with you?
Yeah.
But in
Yeah.
fact, people who are rent investing today might own 10 or more properties
Yeah.
versus someone who owns just their one own occupied home.
Yeah.
And they're
Yeah.
living a much more comfortable life. So again, it's not for everyone, but we definitely want to keep educating clients and educating anyone looking to invest or buy own occupied what might be better for them for sure.
Yeah. It's a completely different thought process, right? Like if you were to say that 20 to 30 years ago and say, I'm never going to buy my house that I live in, I'm only going to rent, people are going to say, are you poor? Is it because you can't afford it? Is that why? Whereas
Yeah.
now, yeah, you're seeing what because and a perfect example is I actually had a client last week. They're getting married, so a young couple that's getting married, and they were kind of thinking about what they wanted to do, and they brought this topic up of rent vesting because what they wanted to do was, buy an apartment, and then as their family grows, they'll grow with the place. So they'll
Yeah.
sell that apartment, buy a bigger one, maybe from there buy a bigger house, which was kind of the trend that you saw people do, 20, 30 years ago. But now, just because of the transaction costs involved and how
Yeah.
easy it is to actually invest in other places, it doesn't make as much sense anymore. Because you're going to buy a property, you're going to get married, you're going to have your first kid, your second kid, and you're going to be like, okay, well, it's too small for me now. Now I need to go somewhere else.
Yeah.
Whereas, you've got to sell it, you've got to wait, no one
Yeah.
wants it, or they're not giving you the offer that you want. Whereas
Mhm.
if you are renting, it's the next day, you're
No
out, the
emotions
contract's
involved.
yeah.
Yeah, it's purely business. That's the best
Yeah,
part. Yeah.
yeah,
Yeah.
yeah,
And
yeah.
I
And
think it's a very handy strategy to have. I just think it always depends on, clients' personal
of course,
like their personal goals. If they're not happy
yeah,
with that rental style, we never force anyone to it.
of
But
course.
if we see that, the unoccupied pathway could be difficult, we definitely just highlight all the
Yeah.
kind of challenges they may face, and we can see all the other alternatives from there.
Yeah, and also I've had couples, buy a property that might not be at the level that they wanted, and then
Yeah.
as they can afford it, develop it, put new kitchen or whatever that may be, and then it turns into the house that they really wanted instead of overstretching themselves from the beginning and then not being able to grow from there, which is another thing that people do as well.
Yeah, 100%. Yeah. Now, I think there's so much conversations we can have. It's always about,
Anyway,
again, what's right for the client. And I think that's
exactly.
why I love working with you guys. It's mainly
Yeah.
about, how do we get to this client's ultimate goal and what's the best way to get there? And it's fully transparent across the way as well.
Yeah, the hardest question I get is how do I get rich? I'm like, man, there's a million. There's not just one way, you know? And that's the great thing that we can kind of, because you're really trying to hone in that buyer's agent space, right? So we're
Yeah.
really confident in you that when we send a client to you, they're doing the most best thing, and there's
Mm.
no emotion involved. It's strictly for the client. And same thing for us from the financial perspective, where we're not just going to say, okay, well, this is how this person got rich, and we're just going to copy and paste it on you.
Yeah.
We try to make, you can only afford this. This is the best thing for you, and this is how we're going to grow your portfolio in the long run.
Yeah. 100%. Yeah. Awesome, man. That was great having the chat today.
Of
I
course,
know we
man.
covered some great topics and I know we'll dive more deeper next time as well.
Of course. Of course, man. Sounds good. It was good to having you, man. Thanks for having me.
100%. Cheers, Phil. We'll speak
Have a
next
good day,
time.
man. Speak soon. See ya. Bye.